Stock-based compensation is often the key argument raised by PLTR opponents. Palantir relies heavily on SBC to compensate its employees. Therefore, it is crucial for us investors to track the progress toward normalization. SBC does not affect free cash flow generated by a company because it is a non-monetary expense. However, it does affect investors. In the last quarter, SBC reached its minimum level since Q3 2020. In that quarter, Palantir completed their DPO. This caused a massive $850 million in SBC expenses, mainly due to special RSU awards linked to the listing. Since then, SBC has steadily decreased and reached a relative minimum to $146 million. We can see from this chart that the general and admin contributions increased after the DPO. This is probably due to the opening or expansion of offices outside the US. SBC as a percentage of revenues is decreasing steadily and reached 31% as of Q2. This percentage should decrease further and help attain GAAP profitability as Palantir scales. Previously, it's been underlined that under conservative dilution assumptions, Palantir should be profitable by 2024 to 2025. This is what Karp said. That combination of radical optionality on expenses and what we perceive to be macro conditions converging with product conditions allow us to kind of see what we think will be a profitable company in 2025. Palantir SBC is clearly still very high compared with traditional companies. However, compared with other peers in the cloud space, we notice Palantir's 31% SBC as a percentage of revenues is well below C3.ai and Snowflake. Their SBC amounts are 43% and 48% of revenues respectively. Interestingly, by comparing the same chart with Q1 results, we notice Palantir is the only company with a decreasing impact of SBC on revenues. As investors, our major concern should not be in the amount of SBC, but in the net effect of the change in the number of shares. Let's assume a company grows 30% like Palantir. The growth per share, or diluted growth for shareholders, would be 30% with no change in the number of shares, about 20% if the number of shares increases by 10%, 0% if the number of shares increases by 30%. Value for shareholders is created only if the business grows more than it is diluting. Palantir's dilutive effect from the increase in share count is decreasing. A wider divergence between the business growth and the dilution creates a greater benefit to investors. This is why it is crucial for the revenue to accelerate and the number of shares to normalize toward 3 to 5% at most. Unrecognized SBC is the amount of SBC that is yet to be recognized from the current plans, which include restricted stock units and options. Therefore, unrecognized SBC hints at the direction of future SBC. As of Q3, Palantir's unrecognized SBC decreased steadily and well below its peak of Q3 2020. Palantir currently has about 1.6 billion unrecognized SBC. This is composed of 826 million RSU with an average vesting period of 3 years and $799 million options with an average vesting period of 8 years. Therefore, we could expect RSU recognition to generate about $70 million SBC and options 25 million SBC per quarter. As a result, we should expect at least $90 million SBC per quarter from the recognition of unrecognized SBC. Despite the fact that SBC doesn't impact free cash flow, the derived dilutive effect is a real headwind for investors. Therefore, as investors, our duties are: consider SBC when we perform valuations. Verify that the growth keeps outpacing the dilution. Track the rate of SBC as it heads towards normalization so that GAAP profitability can be achieved.